Hello, everyone. My name is Marcello Kolax. I'm the managing director at Clever Markets, and we'll just start in one moment. Before we do, I would like to ask you to maybe just say hello in the chat box. That's for me to check if my mic is working, if you can actually hear what I'm saying. So if you would just say hello in the top, you will find a chat box. You'll find a Q&A button. And for today also, if you want to react, you can react. The raise hand button is not so needed for today. Oh, perfect. Thank you very much, everyone. Okay, so we are 3 minutes past. We will just give it 2 more minutes. I very much appreciate that you're here on time, very much so. So we'll just wait until, well, 5 past the minute, past a half hour, as people are still joining. I'll maybe just fill the time. I know we're already recording. I'll just fill the time with a little bit of nonsense, just to tell you a little bit more about me. So I am based in Singapore. I've been here for around 6 years now, and it's wonderful. It's always 30 degrees during the day, and it's always 28 degrees at night. It never ever changes from January to December. And they did get the first Christmas decoration out in 2 weeks ago. Oh my God, yeah, at the start of November. So the Christmas mood is rising. I know it's way too early. It's way too early, but well, why not? Why not? Okay. I think we can give it a go. Before I speak, I'll just very quickly go on mute, and I will very quickly turn off my camera, and I'll be back with you in a second. All right, I believe we are ready to go. Snezana, would you like to introduce us?
Can you hear me?
Yes, we can hear you.
Okay, great. Well, first I want to thank you all for joining this webinar, and I want to thank you that you accept this invitation to support our association and to show people what we do as technicians, how we do the process when it comes to investing and trading on the financial markets. I wouldn't keep you so long. I just want to say that SIMT Association is a newly formed association that promotes technical analysis, education, and certification for the people who want to get certified and become professional in technical analysis, and to help them to develop career as technician regarding the field that they want to do. So because we are already running out of time, I would not hold you too much. So I will let you the time for you, so you can start with your presentation.
Wonderful. Thank you very much. Okay, and I am back now. You can all see me, so you know who's actually talking. All right, perfect. Thank you very much for the invitation. I'm very happy to be here. I think there's a really exciting stage for the association. We're still gathering interest in the region as well. So good times to be around. My name is Marcello Kolax, as I just mentioned, and today we are going to talk about systematic trading, also known as technical analysis. And today's title is Strategies for Profit Maximization because it's catchy. So I could have just called it How to Build Your Own Methodology. So we will stay with this for now. So here is, first of all, a little bit of a disclaimer. Of course, none of this is real trading advice. Just one sentence about myself. So I've been in the energy industry for around a decade. And first I was active on the fundamental side. So every day I would look at like pipeline throughput and storage fullness and weather forecasts and demand forecasts. But I did realize that all these forecasts, they're not very actionable. So there's a difference between understanding why the market is moving, but I still couldn't trade it. So that's why I built the technical analysis department for a different company, for my old company. And I just made myself independent earlier this year with Clever Markets, where we provide daily technical analysis services. So what will we learn today? Just two things. The three pillars of successful trading. It's trend identification, trade planning, and risk management. And we want to understand how you can build your own methodology. So, by the way, today I'm not here to give you like the best tools for this and that market or the best tools or my secret methodology. So no, first of all, there is no secrets. It is all very much basic stuff. There is no hacks. It is just the basics applied well. And I do understand who is on this call. So it's a good mix of seasoned technical veterans, industry experts, people who are maybe active on the markets and want to learn more. So I do understand that the spectrum is very wide. So I hope for the seasoned experts, this serves as a little reminder of the things they're probably already doing. And for everyone a little bit newer for technical analysis, hopefully they will use it as a good opportunity to just start building your own methodology. So who's this actually for? So it doesn't really matter what you do or who you are. You can be a portfolio manager or a retail trader, even an institutional trader, especially, or you can be simply in the procurement department for a big industrial. And it doesn't really matter what you trade, equities, bonds, futures, crypto. We all want to know one thing. Where are we in the market, right? Because if we really break it down, that is the problem. That is the one thing that unifies all market participants and that distinguishes good from great traders, right? Knowing where we are in the market. So we kind of need to know in order to make good trading decisions, is this here just a small correction or complete trend reversal? Is this here completely overblown or is it sustainable? Will the trend accelerate? How do we know that this here is the peak? How do we know that this here is not going to be a complete trend reversal? How do we know this is the bottom? Is there any way we could have known earlier? So this is the kind of questions we are allowed to ask when we use technical analysis. How do we do that, right? Very simple. We need to have a stick system. We need to stick with it, and we need to be able to improve it. It's very simple, but definitely not easy. Okay, so the slide that follows, the next slide. Oh, could everyone please mute, Snezana, could you please mute yourself? That would be great, cool. So what the next slide that's coming up is of, I find to be the most insightful slide of today, possibly, because it is both applicable for everyone new to technical analysis and also for the seasoned experts. Because let's be honest, I'm just taking you to the side now, yeah? how often are we fighting against people who say, oh, no, technical analysis doesn't work in my markets, or technical analysis is like tea leaf reading, or, oh, technical analysis doesn't work. Yeah. So here's the thing. The problem is when people hear technical analysis, all they're thinking about is tools, the mathematical tools. They're thinking about MACD and oscillators and moving averages. And then the people who use it for the first time use it probably understandably incorrectly, because it's the first time. Of course, don't expect them to get it right. And then we get the conclusion RTA doesn't work. So I want to also step away from the phrase of like TA is predicting the markets. It's none of that. We are not predicting. We are not forecasting. Technical analysis is not a crystal ball sort of thing. Technical analysis only does three things. TA helps with trend identification, trade planning, and risk management. All right, trend identification. And oh, before I go into this, it is never a fight between technical and fundamental analysis. They both work together. You need both if you want to fully understand the markets. But if you want to trade them, definitely you have to deal with TA sooner or later, because it is these three things. So how do we use TA? First of all, it tells us when a new trend is about to start. It tells us when a trend is like fully confirmed. And it tells us when a trend is like slowly topping out and about to reverse. And it tells us when the market is fully reversing. Why is this important? Well, in an uptrend, we are trying to make buying decisions, right? So we are trying to buy the troughs. And a downtrend, we are trying to short sell the peaks. So that's why it's so important to identify the trend. Then the next thing that technical analysis helps with is trade planning. So TA very specifically tells us like when to enter, where a potential target is, and also when do we know that we are wrong, so we put a stop loss there. TA helps with exactly that with a very systematic way. And once we know where to enter, where to exit, and where the stop loss is, then we can start applying risk management. And then we can do like calculate the position size. We can calculate our risk reward ratio. We can start hedging with futures if you're in the purchasing department, procurement department. Yeah. So can you see at no point am I saying we are predicting the markets? We are always just going with the flow. And understanding technical analysis in this manner, nobody in their right mind can say TA doesn't work. Because now the question becomes, what doesn't work? Trend identification? Knowing where to enter? Calculating your risk reward ratio? What exactly about technical analysis doesn't work? Can you see? So I hope for all the seasoned experts who've been fighting for years to make people understand TA, I hope I got it out there now. This is for you. That's for free. Okay. So I hope you appreciate that. All right, so here's the thing, yeah. So TA is for trend identification, and so is fundamental analysis. And then on top of that, in order to make more sense of the fundamentals, we apply the trade planning and the risk management. So trend identification tells us what to do, buy or sell. Trade planning tells us when to do it, yeah, where's the best entry. And risk management tells us how much we should allocate. Okay, make sense? Cool. All right. So now let's go to the meaty bit. Let's talk about the Clever Markets methodology. Okay, so in our blurb for this meeting here, we did write that we have a strategy that works between 60 to 94% of the time. So what is that based on? Well, that is based on for those of you who are familiar with that, on the MAE and MFE. So this is not a trading performance. It is a analytics performance, essentially. Yeah. So those in the know, they can make sense of that. Essentially, it says that on average, with this methodology, you're able to capture at least 60%, maximum like 94% when you're really good with like bottom and peak picking. This is over the past 4 rolling quarters, so it's always updated. That is what we work with. Okay, so here's the thing. We did not reinvent the wheel at Clever Markets. This is box standard stuff, and all the experts seeing this, they'll probably nod along because they know how important it is. And like 90% of the gains are contained within the simple basics. Everything else is just a little bit fancy. Okay, so you can see we have 3 categories: charting, mathematical tools, and macro tools. What do we do with that? We want to have at least one charting tool agree with a mathematical tool before we make a decision. So we want to have like a support and resistance. So like a new trend, we want to have that identify with support and resistance and the trend and momentum tool. If we do see like a small candle pattern, we want to confirm that with an oscillator. So we always want two of them. We would never just trade on a tool, and we would never just trade on a charting pattern. And then we do have macro. We just put the whole market into context. I personally do not use Elliott wave, but it's good there because I know it is still a little bit popular. So let's have a look at this, and all of that essentially, yeah, support, resistance, trend identification, large, small patterns, all of that will help us with the three pillars of technical analysis: trend analysis, trade planning, risk management. Okay, you ready? Cool. Let's start. Support and resistance, what is it? Okay, so first of all, support and resistance is essentially where the balance of supply and demand is shifting. Yeah. So if we hit a resistance level, that's called a supply zone. So there's more supply coming into the market. Yeah. Then this drives the market down. And then into the support zone, in the support area, which is called the demand zone, people are buying it up. Okay. So that's essentially what it is. And there's support and resistance can appear in various places. So first of all, a classic would be that old support can turn once it's broken can turn into resistance. This is very important and very powerful, especially in the Brent crude. So that's why I'm looking at I'm more in the energy industry, right? Then historic peaks and troughs, very simple. That's a classic, nothing new here. So if we have a peak or a trough in the past, then it's very likely, or then there's a chance of it being hit again. Next one is Fibonacci retracement levels. And we are not going into Fibs too much today, but it is simply telling us how much, like after an uptrend, how far the market can retrace. And these Fibonacci retracement levels are expressed in percentages, give us good waypoints. If we break below 1, then we are likely to make it to the next, then we are likely to make it to the next. So that's what these help us with. Then, of course, classic moving averages, they can offer support. It's usually the ones in the like 20, 50, and 200 that are like the big important moving averages that can offer support or resistance. And then, of course, if we have like a formation, yeah, like this is like a sideways trend, this is like a rectangle here, yeah, and if we break above it, then we have something called throwback, or so it's a throwback, or here in this case a pullback, yeah. So you can see this is very similar to the support turned resistance here. We are testing it again, and it's holding, and we go higher. But the condition here is that we actually had a pattern. What patterns are, we'll talk about in just a bit. And then, of course, round numbers. Round numbers are psychologically so important. So if you have a market approaching the number or the price 100, there's a good chance that we are finding some resistance there. Why? Because we're human. If you watch TV, probably you don't have the TV on at, I don't know, volume 18. Probably put the volume to 20, right? That's, to be honest, that's that. When traders talk to their colleagues, they're never saying, "Oh, I put resistance, I put my stop entry at 2785.963 or something." Yeah, they just boom give you a real number. Humans, strange, right? And there is 3 ways of actually confirming the break, because support and resistance is important when it holds, but it's even more important when it breaks, because that means that the market sentiment has been changing. So now the question is, okay, so how do I know it has actually broken? Because we do see that all the time, like a wick is like penetrating, or it's like almost there, but not quite. So how do I confirm that the level has actually broken? Well, there's 3, well, actually 4 key methods. The first one is 3%. What does that mean? It means that we have this support level. Yeah, let's say this was like some sort of pattern, and we want to see this number here, this price where the support is. You can put in your calculator the price minus 3%, and that's when we would have the break confirmed. Why 3%? Well, it is a little bit random. 2 is too little, 4 is too much, but 3 is like the textbook method. Then what I like a little bit better is 2 consecutive closes. So 1 close can be a fake out, but 2 closes, I kind of want to, the break is a little bit more confirmed. So 2 consecutive closes. The third bit would simply waiting for the retest. So let it break and then simply wait for the retest and then enter here. And if that holds, then we can enter short. However, the market doesn't always retest. So waiting for it would make you probably miss out on a lot of really good trading opportunities. So that's why the retest is often used to just confirm a position, maybe add to it usually. So, and a fourth method is actually ATR. It's called the average true range. And I'm not going into detail here, but those who are a little bit familiar with it, the ATR is an indicator. It's just one line, yeah, on the chart that gives you a number, and it is a representation of volatility. So essentially, you can place your the entry candle has to be the size of 1 ATR or 1.5 ATR, just to show that yes, volatility or like the market boom is there. We are really going through, not just with like a tiny candle that breaks lower. Okay, make sense? Cool. Why does support and resistance matter? Well, we can do quite a few fun things with this. We can trade the break. We're breaking out of a sideways trend. We can trade that and then establish a new direction. We can start trading the swings. So remember, in a downtrend, we are looking for selling opportunities, but best, of course, in the peaks. So here we would know, okay, so we go until here with all the levels that we have established previously and in the previous slide, right? And then we move lower. Then you can simply trade within the boundaries. So there's a lot of fun, especially when you have good patterns going on that like develop over like weeks and sometimes months, but definitely really useful. And then, of course, we do have trade trend reversals, which simply means, okay, the entire trend is reversing now. So essentially, this is where you enter and exit the market. So it's pretty important. So what's the first bit we want to do when you build your methodology? First of all, memorize when support and resistance typically occurs, and then you need to decide how you want to define that the market has broken. Yeah, 3%, 2 consecutive closes, 1 ATR, 1.5 ATR. So that's a decision that you have to make. Okay. Next things, trend identification. What is a trend? Okay. There's people who have been trading for many, many years, and I advise some of them. And this sometimes is not entirely clear, and I completely get it because nobody really explained it to them ever. But there essentially is a definition of what an uptrend and a downtrend is. So an uptrend is simply higher lows and higher highs. Huh? Okay, get it. A downtrend is lower highs and lower lows. Makes sense. And then, of course, a sideways trend, we don't really make any advancements into either direction, or we move into an increasingly tighter range. So in practice, it looks something like this. So you can see we have like the higher highs, the market is pulling higher, and the lows are also moving higher. Same with the downtrend, we have like lower lows and lower highs, the market is swinging lower, just the general direction of a trend, and then also the same for the sideways trend. So how do we use it, trend identification? Well, it does tell us when the trend reverses. And that is so important. Because here's the thing. Now we know, and by the way, get your hands ready. I want all your participation, please. So I want you to type into the speaking box stop, yeah, and I want you just to hit enter when we are here. So my question to you now is, when does the trend reverse? So obviously, visually, we have an uptrend here. We have a downtrend here. And an uptrend is defined by higher highs and higher lows. Good. And a downtrend is defined by lower lows and lower highs. Okay. So here's the thing. We have a peak, we have a lower peak, we have a low, and we have our first lower low. But like, where does the trend actually reverse, right? Where precisely? Okay, so I'm looking at my at the chat box right now. Give me a second. Okay, so I'm looking at our chat box. And I will trace this, and you tell me, you hit enter, you say stop, when you would say, now we're moving from an uptrend to a downtrend. Okay, I'll give you a second. I am going very, very slow. I want you to hit enter, okay? Obviously, still an uptrend, got our trough here. We're moving higher. And now I'm quiet, and I'll just see what happens in the chat. Okay, we got our first one. Stop. Okay, cool. I'll just I'll just continue just in case anyone else is a little bit later. Okay, I see a stop. Okay, in the lower low. Okay, cool. I'll just continue this. All right. Okay, cool. We got one probably this year, I assume. Yes, good. Got it all. Thank you very much. So can you see, by the way, this is a good case study for anyone who's ever arguing with people about TA. When people say TA is a self-fulfilling prophecy, obviously not, because we all know what an uptrend is. We all know what a downtrend is. But the interpretation of when we switch is not, there's no unified consensus, right? So if anyone ever tells you TA is a self-fulfilling prophecy, well, if only, right? Okay, so here's my interpretation of the thing. So obviously peak, lower peak, okay, low, lower low. So somewhere here, I would argue that we would switch from an uptrend to a downtrend at this point. At this point. Why? Because at this point, for the first time, we would actually be able to form a lower low. So if we have a peak and a lower peak, then wait, I'll get out a pen. Okay, so if we have a peak and a lower peak, yeah, this is happening, and we hold here, then this could still turn out to be a sideways trend, right? And we don't want that. We want to avoid getting short and then being caught up in the sideways trend for ages. So that's why moving below here would assure that for the first time, we actually have it confirmed a peak and a lower peak, and everything what's below this level here, everything below this level would automatically constitute being a lower low. So as per textbook, this would be the way to identify the switch from an uptrend to a downtrend right here. Now here's the thing. It doesn't mean you can't profit from getting in here, and absolutely it does not hurt if you get in here a little bit later, yeah, if you wait this whole thing out, because it depends on what strategy you're working with. If you're like an intraday trader, you don't really care. You can just do what if let's say this is a daily chart, yeah, and you try to trade this intraday, you're just anyway trading both sides of the market possibly. If you're like a big swing position trader and you're planning on holding the position for like months or weeks, then maybe the precise entry isn't that important. The important thing is that you get the market right. So I fully understand that some people wish to enter a little bit later, some a little bit earlier, and some are just with a textbook definition. All works. Here's the thing. There is a difference between analyzing the market and trading the markets, right? So probably we would have gotten some intraday reversal signals a little bit earlier, so we could have entered shorter a little bit earlier. But this could be only a deep correction of the uptrend. Okay, so now we have one participant mentioning that this here could only be a deep correction to the preceding uptrend. Yeah, it depends on what. So I think here it is important that we start talking about. Okay, we need to move on. That we just quickly mention the time frames. Yeah, for this fictional example, for this time frame, the textbook definition would have been this. So the idea, I'm sure, what the there you go. What the colleague is mentioning right now is, if we are just waiting until here, what is to say that we are not going to move higher here? I'm just assuming that's what the participant said. How do we know that's not turning out like this? Absolutely, we do not know that, and we are not predicting the markets here. What we are trying to do is we identify the trend, we plan our trades, and we do risk management. So here's the thing. Nobody could have known. Nobody ever knows what the next move of the market is. Yeah? And anyone trying to explain to you that they do know, that they're probably lying or trying to sell you something. But just by textbook, at some point, we need to actually go with a downtrend. I personally had that problem for a very long time. I was always waiting, okay, one more level of confirmation, one more level of confirmation, one more level of confirmation. And then I ended up just losing out because I got in way too late. So, but this here is like a good medium way of essentially like helping with that. Why is it important to understand when you're in an uptrend or a downtrend? Well, in an uptrend, if you're a swing trader, that's just the most popular way of trading, right? Um, you're looking to buy the dips because you can see if we enter here and then we take profit here, yeah, enter here, take profit here. So the up legs are always in favor of the of the uptrend, and like the down legs are always a little bit longer in a downtrend. So if you go short here, then get out here, go short here, get out here. That's what we use it for. So the next thing I want to put on your to-do list for your methodology is you need to be able to identify when a trend reverses. And here's the thing, it doesn't have to be the textbook identification. It has to be the identification that works for you and for your markets. You have to be comfortable with it. But it's important that you first understand what is the baseline and how much do I want to deviate from that. If you're an expert, you already know what you're doing. If you're new to technical analysis, I recommend going with the textbook definition first, get comfortable with it, and then over the years you can adjust it. For example, what I personally do, I work with moving averages quite a bit in order to identify a trend reversal. But of course, we do want visual confirmation from the graphicals. So trend lines and channels, still basic, very, very basic, of course. So an uptrend is tentative if we have like two lines, we have the line match hit 2 points, yeah? And that's just a tentative trend line because we can connect like any 2 points on a chart, right? Doesn't really matter. So we want a third one so that we can actually have it a confirmed trend line. Out of habit, and I recommend you do the same, out of habit, I always copy this line and then just see, can we turn this into a channel? Even if there's just one peak for now, I like to turn it into a channel immediately. Of course, downtrend, same, and we are trying to connect the peaks. So now is the question, what counts as a hit? And here's the thing, it is controversial. Here's what we are working with and what has served as well. Because we try to understand trend lines not as like really defining factors of the market, because we can draw onto the chart whatever we want. Doesn't mean we can tame the beast, yeah, the market. But trend lines are there to just help us make decisions. We are not making trading decisions based on on the trend lines. So here's the thing. This here is an ideal hit. We have the lower wick hit exactly. Then we do have like what I like to call a good enough hit. So I actually would call this more or less a hit. Yeah. And then of course we do have a little bit of like a wick penetration, but the body stayed above it. A fourth option would be if we simply have like one candle moving below it briefly. If we just have like one candle body like this, and then the market continues higher immediately, that would also still be okay. Because remember, the definition, the invalidation would be 2 consecutive closes or 3% or the ATR, right? So why is it, how do we use that? Well, first of all, it helps you to visualize when the trend is accelerating. It shows you when you are maintaining within a channel, and it tells you when we are not hitting the upper boundary anymore or the lower boundary in a downtrend, then probably the market is due for a downside correction. So I find this incredibly powerful. And why does it even matter? Well, it helps us with 3 things. We can trade the swings, right? So go short here, and then as soon as we touch the lower end, then we exit here, yeah, for example. Very simple, very basic stuff here. The next thing is it helps us to get out early. So here's the thing. Do you remember when we talked about what counts as a trend reversal? So in this example here, we would have to wait all the way until here, right? Because we've got a high, lower high, low, lower low. So we'd have to wait until there. But the thing is, what we could have done, we could have also just simply drawn in a trend line. And then we see that the trend line is always giving us an earlier signal. Same thing here. So we have a low, higher low. Okay, warning. We have a high, and the higher high is only happening at some point in the future. Yeah, not even on the chart here. But we could have gotten out of it at this point. So here's the thing. How I use it. we are in a downtrend. We are no longer hitting the lower end of the boundary. That's a warning, probably lightening up the position. We break above the channel. I exit the position. I don't go long. I just exit. Now I have the time, I have the luxury of waiting it out before we get the uptrend confirmed, because this it could very easily be a sideways trend as well. Okay, so the next thing is you need to decide how lenient you want to be with your trend line drawings. It's important. So now that we understand what support and resistance is, how to draw trend lines, how to identify a trend, it makes sense to start talking about patterns. So these patterns essentially are just two support and resistance levels shaping up as a pattern, just in very simple terms. And there is really big pattern libraries out there, and I am not even attempting to go into the details here, because it's so much, yeah. But I do encourage you to go to the pattern site by Bukowski. He is a icon of technical analysis. He's a true expert veteran, and he has a very useful site called the pattern site. You can Google that, and he has a big library of the patterns and how often and how they work out and what the conditions are for the market to actually for the pattern to actually be fulfilled. And what do we use them for? Well, usually they do form at like important reversal points, and they can form over like weeks and months. So of course, if you heard of some of them, like triangles, rectangles, the most famous one is head and shoulders, of course. And that's the kind of stuff that non-technicians are surprised by. Yeah, they simply don't understand how drawing a few lines on a chart can lead to any predictive results, which is an error, of course, because we are not trying to predict anything. The only thing what we are trying to do here is we're trying to establish, are we actually topping out, or is this a correction? And then how do I act with that? Yeah. It helps us to trade the range, not in the case of a head and shoulders, but if we would have like a sideways range, yeah, or like a triangle, that would help us as well to trade the boundaries. And it helps us to confirm that, yes, indeed, the trend has changed from an uptrend to a downtrend. And these big, large patterns, they're so powerful because it doesn't just happen like in one tiny move. Yeah. No, the market takes its time. It's thinking through it for weeks and weeks and weeks. And the conclusion is, yes, the trend is reversing. So that's why a break lower or past a pattern is so powerful. Well, you know what's also powerful? If the pattern briefly resolves and then goes in the other direction again, because that shows that like after weeks of deliberation, the market has decided, nope, we're continuing with our original direction. Oh, and of course gives targets. Okay, so why is this important? Well, because it helps us with the trade setup. Remember, technical analysis is for trend identification, trade planning, risk management. And patterns help us with all three things. Trend identification, the trend is reversing. Trade planning, well, we put a stop loss here and we enter a short trade there and we take profit there. Trade planning. Once you have these established, risk management. So can you see how being able to identify patterns helps you with being a better, more profitable trader? So the next thing is you need to understand what the patterns are and you need to understand the criteria, and you actually need to have that in your head. If you're working with like a more modern charting software, sometimes they have like automated identifications built in. Now that we talked about big patterns, I want to talk about small patterns. So these are simply visualizing the psychological state of the market. And there's like 1, 2, and 3 candlestick patterns overall. And the more candlesticks the pattern exists of, the more confirmed it is. So like for a 1 candle pattern or like a 2 candle pattern, we always like want one more candle for confirmation. Yeah, before we go, okay, we have a downtrend. We have this pattern here called the bullish harami, and then the market moves higher after that. So we kind of want to see like a 3rd candle confirming this. But if you have any like 3 candle patterns, then already that's a confirmation baked in. So you don't really need a confirmation. So I'm not going through the millions or not millions, but the very many candle patterns that do exist. I'm not going through them, but I give you some general guidelines. And those are, if the bodies get smaller, that means that the confidence of the market is deteriorating. And also, if the wicks get longer and the bodies are smaller, that simply means hesitation is growing and the market is feeling out the direction. So what it essentially means is like, here we are confident. We open and we close there. Boom. Here it means we open and then, we are testing out. No, it's not this direction. It's not that direction. Okay, still higher. Can you start seeing how it works psychologically? And then up here, we go like all the way up here. We drive the bulls are very happy up here, but then they lose their confidence quite a bit, and in the end they more or less ended up where they started. So it wasn't a good day for the bulls. So decline is more likely. And the longer the wick, the more important the level that is hit. Yeah. So watch out. Maybe it is a round number. Maybe it is a historic peak or trough. And then once again, the bodies get longer, confidence is growing, the market is continuing. And if you have like high volume at a candle, that makes it more, the conviction is higher. For example, if this here was like a strong green candle, but there's no volume, well, maybe that means there was only a handful of trades going through. And because there was no liquidity, the market simply just jumped, right? So in order to see conviction, we want to see high volume with the candles. Why do small candle patterns even matter? Well, they help us with trade planning. So as I said, here, for example, this candle pattern is called a hammer. So a hammer appears after a downtrend. We don't need to go into details here. Yeah. Then we have the hammer here, and then we have the confirmation as soon as we break above the hammer candle, and then we get a bullish signal. Once again, remember the Clever Markets methodology. We would never ever just trade on this alone. What we want to see is confirmation from a tool, ideally an oscillator. I like to use oscillators for like small pattern confirmations and like trend lines and trends. Sorry, trend lines and new trends. I like to confirm them with trend tools and momentum tools. So now we need to learn what the small candle patterns are. Okay, cool. Can you see now we are all the way down here? We are nearly done, and not once have we talked about mathematical tools. Isn't that curious? So here's the thing. You can be a very good trader by only looking at the graphical tools, or just that's called chart reading. Everything that we learn now, like trend, momentum, oscillators, volume, and volatility tools, they are secondary. They are visual aids. They show us apologies, what is already on the chart. They are just derivatives, essentially, of price. So, and the thing is, like a lot of outsiders get hung up on those. But can you, and I want you to explain this to your customers maybe as well, maybe to remind them, when anyone says, oh, I know technique analysis, I used stochastic ones and it didn't work. Well, they are focusing on a subset of a subset of a subset of tools available for technicians, right? So we have like graphical mathematical tools, and then within mathematical tools, they look at oscillators, and within oscillators, they start looking at the stochastic, and then within the stochastic, there's like different, of course, variations where you can adjust the tool itself. So I understand why people get it wrong. And to be honest, we all in the industry, everyone participating here, everyone being engaged with this association, it is our job to help people understand this, right? We're trying to do the good work here. Okay, cool. So what are trend tools? Well, they signal the direction of a trend. They give only two signals, bullish or bearish. So that means they're really good for trend following strategies, but they simply do not work in sideways trends, because then you're being just thrown in and out of the market most of the time. Some good examples of trend tools are ADX, moving averages, and Ichimoku Cloud, which Ichimoku Cloud is like its full system in itself. So here's the first question. What trend tool do you want to use? There's so many available. We are not going into them, but I want you to pick the one trend tool that you understand the most, the best intuitively at first. Same with momentum tools. So they indicate if essentially is a trend is like strengthening, sustaining, or weakening. So if we see divergence, so divergence simply means the momentum tools going down, but the trend is still going up, that's a sign for me personally to lighten up my existing position a little bit, because there's a good chance that the bulls in this case are exhausted and that the trend is more likely to reverse. I don't really act on that all that much. I really want to see a trend line break. I want to see other confirming tools, right? But there's one early indication. And here's a good thing. It usually helps us distinguish between corrections and trend reversals. And I hope this helps answer the question of our that we had earlier here in the chat. Maybe it is just an extended correction. Yes, possibly. And for that, we would start looking at momentum tools. Because usually, on average, we do see that if we are in an uptrend, now I'm putting the tools together already. If we are in a confirmed uptrend, the momentum is usually remains strong even if we have a little correction. The tool that reacts to those corrections the most is oscillators, and we talk about oscillators in a moment. So if we get a bearish signal on an oscillator at the peak of a market, and we start moving lower, and we get another bearish signal confirmed from an oscillator, but the momentum is still strong, then it's more likely to be just a correction. Okay, cool. So which momentum tool are you going to choose? And can you see it's a single, I'm trying to ask you just for one trend tool, one momentum tool, because there's so many out there, but it's best to just work with the one that you understand the best. Then of course we do have oscillators, and oscillators oscillate. So they simply show us overbought and oversold levels, and all oscillators are calculated in exactly the same way. So they simply show us if the market so the closing price right now, where is the closing price right now in relation to the preceding, I don't know, 5 days, 10 days or whatever. So, and the signal is not given by moving into the overbought, oversold signal level. It's given by moving out of it. So all the experts in the chat here, they're probably nodding along. They know, okay, absolutely, that's the basics. But I hope I'm helping at least one person with this. So once again, moving into the extreme level is never the signal. Moving out of it, that is the bearish signal here, and we get a bullish signal here. Okay, cool. So choose an oscillator. Okay. Next bit, volume. Okay, volume is a leading indicator because usually the volume moves before the market does. And do you remember what I said earlier? I want like some strong volume behind a move in order to have it confirmed. Absolutely. Because can you see like the volume is slowly declining while the market is still moving up? So that means that we are probably hitting a peak at some point fairly soon. You would never just make a trading decision based on volume. It is just one more piece of evidence. And then once we have the downtrend, volume confirms that we are very strongly bearish. So this also helps us to like be more confident with the direction that we have chosen. So of course, please do choose your volume tool. We're a little bit limited here. We have the OBV, it's called the on-balance volume. And we have the volume bars that you have seen here. These are the two main volume tools available to us. And of course, the last bit, volatility tools. I don't want to spend too much time on this. I just want to explain the difference. There's a difference between volatility and risk, right? So volatility simply means high volatility. The market is moving frantically past its mean average, whereas low volatility means we are closer to the mean average. So what's the definition of risk? Well, risk is simply permanent financial loss, or the chances of permanent financial loss. And of course, you can just as well lose money here, but you have more chances to lose money in a highly volatile market. So although risk and volatility are correlated, they're not the same. I would like you to actually look at the ATR. It is not very intuitive, the tool, admittedly, but if you're new to it, give it a chance, truly. There's a lot to do with the ATR. So why does it matter? Why does all this like trend confirmation with mathematical tools matter? Well, first of all, we can filter and monitor a larger universe of instruments. So for example, I only ever look at 10 instruments, and I can do that in one day. I don't need to filter that. But if you are looking at the S&P 500, for example, and you want to see like where are the best trading opportunities, you can actually set up your systems for filters. Like I only want to look at I don't know, stocks that are above their 50 moving average or something, 50-day moving average. Yeah. So you can filter a larger universe for specific criteria. The next thing is it helps us anticipate price movements. So once again, we have this divergence happening, or no, not really. So we have like a sideways trend here. Yeah. And we do see, stochastic is moving higher. Huh. What does that mean? So that means that eventually a break higher is more likely. Same with the MACD. We're not going into details here, but that's a trend momentum tool. Yeah, the MACD is pulling higher while the market is still moving sideways, so we are more likely to break higher. And of course, volume you can see on the down leg, volume goes down. On the up leg, volume goes up. Here we go down with the volume, and then boom, eventually we peak. The next thing, technical mathematical tools help us with is the alert of impending price changes. Yeah. So I just marked some points where, in this case, I'm using the stochastic, where the stochastic gave us essentially bearish and bullish signals and how the market reacted with that. And the last bit, it simply helps us to confirm a breakout. So if we move above a range, for example, and we do get a bullish tool, then it's like a good confirmation. So in summary, technical or mathematical tools help us to filter, anticipate, alert, and confirm trends. All right, now let's talk about trend reversal warnings. This is the exact process, but kind of in reverse, right? So the first thing that weakens is probably, so if we have if you have an uptrend, and we do see that, oh, okay, so the tools are getting a little bit more bearish. Maybe the trend tools and the momentum tools are weakening. So that's a sign that we might be topping out. Maybe we do get a larger pattern here at the peak that's showing us that, yes, indeed, we have peaked out. Maybe we can trade the smaller boundaries of this little pattern. And then eventually we probably get like a, apologies, we get a trend line break or a channel break, which is like, okay, get out of this position. And then we do have like the full trend reversal. You remember higher highs, higher lows, lower lows, lower highs. And then this is like the process I use to get warnings of the market actually reversing. And there's the thing, then it starts all over again, right? So this is the warnings of a trend weakening. And then we just go all the way up with when we start confirming the start of a new trend, right? So it's kind of like always the same, always the same, always the same. And we need a system in order to be consistently profitable. And I encourage you to have one, even if it's bad, because if you make an error consistently, you can improve it. Okay, so why does it matter? Well, as I just explained, first the tools move, then we move below the trend line, right? And I like to close on my positions there, but only enter a little bit later. So that's what I like to do. Okay, cool. So now in our to-do list, what's the next bit for you? You need to know what trend reversal warnings you would like to incorporate into your methodology, and how you adjust your trading behavior. So for me, I keep mentioning break below trend line, get out of it. Yeah. And that is it. So essentially, we need to make these decisions to build the most basic technical analysis methodology. And if you're new to it, I encourage you to play around with it. Don't really trade on it. You can, if your setup isn't that sophisticated, you can just manual backtest. Just select all these rules, go back into the past, and see how this would have worked out for you. For everyone more advanced, I know that all the experts now, they're nodding along. Yes, that is the basics. And here's the thing. The experts always do the basics. Just because you become better doesn't mean you stop doing the basics, right? So that's why it's so important for everyone starting with technical analysis to really get good at this. So the most important part here also is the implementation. Yeah. So all of this was for nothing if you're not actually implementing it. And I do truly encourage you to work with a methodology. So it sounds like a lot, right? It is. But here's the thing. Imagine the cost of not doing it. If you choose not to implement a methodology because you would need to get some external expert help or it would take too much time and effort, I promise you, you are already paying for it, but you don't know. You're paying for it in the form of you're not getting into the good trade that early. You're getting into it like just a little bit too late. You're exiting the trade just a little bit too late. And it's always just this like 1%, 2% over weeks and months and years and tens and hundreds of trades. That is the cost that you're incurring by not working with a methodology. So if you think you're saving time and money and manpower by not implementing it, I promise you, you are already paying for it. Okay, but no worries. You don't have to do it alone. So I was very happy that I was invited today. So of course I would like to share with you what I'm actually doing. So Clever Markets is a little bit different. Yeah. So what we do is we bring the capabilities of a strategic trading analytics desk in-house for the fraction of cost, zero effort, and instantly. So no more PDFs sent out to the customers like it's 2003. We actually do have a full-on dashboard. There's daily analytics advice, get a weekly one-on-one call with me personally. So if you are in the market to actually elevate your team to the next level, then I encourage you to contact us. Technical analysis and the Clever Market Services specifically work best for clients that already have a solid fundamental model built out. Because with technical analysis in general, you're able to squeeze more value out of your existing fundamental models. So whether you go with me or anyone else or just try it on your own, I encourage you to start working with systematic trading. All right, but here's the thing, market analytics is too important to do it alone. So let's do it together. If you want, you can get in touch with me. That is the very last slide. Oh my God, we are exactly on time. That is amazing. Thank you very much, everyone. If you do have any questions, then now is your time. I'll just give it 1 or 2 more seconds. And while you are typing out your questions, I'll just maybe talk for 1 second. So personally, I feel like technical analysis has had the biggest positive impact on my career and my trading, and I'm very happy that I did it. I made the move from fundamental to technical analysis. And if you're not already in the market or doing it, I highly encourage you to do it. I know there's a lot of experts in this call already, so I hope this helped you like refresh a little bit as well. I do have the CFTE qualification as well that I use. At Clever Markets, we have our own technical analysis courses, or it's essentially an academy as well that will launch. The next one is in March, essentially. All right, check out clevermarkets.com. Cool. Snezana, any final words? I will give it back to you. Thank you very much, everyone. Thank you very much. I'll stop sharing my screen. All right, there doesn't seem to be any final words. Then I'll just do it. Thank you very much, everyone. You've been amazing. Check out the association. Check out the IFTA. It is they're doing really the good work, trying to bring a little bit of technical knowledge into the industry. Do check them out. Have a look at clevermarkets.com as well. You've been amazing. Have a good day and see you around. Bye bye.